Hi, why I stopped buying the S&P 500? The S&P 500 UCITS ETF SPYL is my single largest investment position at over 300,000 US dollars. And I have not added a single unit in months. Not because I think America is collapsing, not because I'm panic selling. I just made a deliberate decision to stop adding and start putting fresh money somewhere else. In this video, I want to walk you through exactly why I made that decision, what am I buying instead, and the specific ETFs that I am using as a Singaporean investor. And if you are new here, my name is Chris, an ex-chartered accountant turned personal finance YouTuber, and I run a Telegram group of close to 23,000 members, so you can join us for like-minded finance discussions there. But I want to be very clear that today's video is not a real financial advice because I'm just sharing and documenting what I have done. And you may have very different financial situations, so please don't take it at face level because past performance is not the guarantee of future results. But I want to carry on with this topic on why I'm rethinking the S&P 500. And let me be very honest, the S&P 500 has been phenomenal. The last decade of US tech dominance has been genuinely historic. Nobody can dispute that because that's a fact if you look at the chart of the S&P 500. But here is the thing that I keep thinking about. US dominance is not a law of physics. It is a condition, and conditions change. I'm not saying that the US is going to fail. In fact, I genuinely think that that may not happen. What I'm saying is that the rest of the world is not standing still. They are catching up. We are talking about Europe, Japan, South Korea, and Taiwan, all hitting record highs this year, despite having enormous growth already in 2025. And with everything happening around tariffs, trade routes, de-dollarization, and assumption that one country keeps outperforming everyone else indefinitely, that is a strong bet and a very concentrated one. And maybe this bet is too strong to have your entire portfolio riding on it. Then there's also a currency angle. And a huge chunk of my portfolio is already USD denominated. For every dollar I put into SPYL, adds more currency concentration. And if the US dollars weakens over the next 10 to 20 years, that will impact my performance even if the underlying stocks are fine. And honestly, this is the most personal reason that I'm not in my 20s anymore. I'm in my mid-30s and I cannot invest like a 20-year-old, okay? My portfolio has grown to a certain size, and with this certain size and a certain stage of life, you start thinking about resilience, diversification, not having a single point of failure. So I'm genuinely okay to give up some of the outsized returns for that stability. So yes, I'm aware that I'm also giving up some of those outsized returns to get a little bit of peace of mind. But I want to be very clear with this message. I am not going to sell my SPYL. I'm not going to sell this S&P 500 allocation, okay? I am not liquidating this part of the portfolio, and it's still going to be my largest positions, and I have zero plans to liquidate it. What is changing is my buying behavior. So I will stop directing fresh capital, fresh funds into SPYL, and I'm now building an exposure outside of the US instead. So if you go onto online forums and you want to talk about diversification outside of the US, I think there's a very obvious option with this ticker known as VXUS. Okay, if you want broad international exposure, this is the most well-known option, the Vanguard Total International Stock ETF. And for American investors, this is genuinely a great fund. Okay, it is diversified, it is low cost, it has massive assets under management, and available on all the major brokers. But here's the problem, especially for Singaporean investors. VXUS is US domicile. And for us Singaporeans, there are two issues. Number one, withholding tax. VXUS has a high dividend yield of around 2.6% because it holds stocks from all over the world, which many of them pay decent dividends. And as a Singaporean holding US domicile fund, you get hit with 30% dividend withholding tax on every single dividend. So that is quite a significant tax drag of around 0.78%, and that is compounding against you every year. That's issue number one. Issue number two, US estate tax. Okay, since you're buying a US domicile ETF, it will fall under the US estate tax regime for non-US persons. And if your US domicile holdings exceed 60,000 US dollars and something happens to you, your estate could face up to 40% tax on everything above that threshold. And you see, the purpose I bought SPYL is to avoid the dividend withholding tax and the US estate tax. And that is already working. So now if I go back and buy VXUS, it's like slapping my own face, right? So VXUS is not going to work it. It's just not it for Singaporean investors, especially with the tax drag and the estate taxes. So we need to look at the next solution, which is UCITS funds. Are there any UCITS funds that could replicate VXUS. And here's the truth where I'm going to disappoint some of you. There's no single UCITS ETF as of now that can fully replicate VXUS. There's no clean one-to-one substitute, but you can build an equivalent exposure yourself, and it only takes 2 funds. Okay, that's the good news. And the quick context here is that I know many of us, we own something called VWRA or ACWD. And let me give a quick context. VWRA, one of our most popular FTSE All-World Index UCITS ETF, which many of you probably hold or you know about, is roughly 60% US exposure, 30% developed markets exposure, and 10% emerging markets exposure. This is just a rough estimate lah. Okay, so if I already have SPYL covering my US market, I just need to fill up the other two, which is the developed markets outside of US and emerging markets. And this is exactly what these two UCITS ETF are going to do. The first ticker is EXUS, or just call it EXUS. The full name is known as the X-Trackers MSCI World ex-USA UCITS ETF, and it covers large and mid-cap companies from global developed markets, excluding the United States of America. And if you look at the top 3 countries, we are looking at Japan, UK, and Canada. Top 3 sectors-wise, we are focusing on financials, industrials, and healthcare. And you realize tech is only 9% of it, which is very different from S&P 500. And if we zoom in on the top 3 holdings, we have ASML, we have Roche, and AstraZeneca. All these are established global businesses that are genuinely not correlated with the Silicon Valley companies. Cost-wise, we are looking at an expense ratio of 0.15% per annum, and it is accumulating. That means that the dividends are not paid out, they are reinvested back into the fund itself, which is good news because it reduces the tax drag for us instead of us having to reinvest those dividends. And because this one is UCITS compliant and Ireland domicile, we avoid all the dividend withholding tax plus the estate tax issues. Okay, so the second fund that you should look at is EIMI. Okay, this is for the iShares Core MSCI Emerging Markets IMI UCITS ETF, and it covers the emerging market slice that tracks the performance of an index composed of large, mid, and small cap companies from emerging markets. Now, when you see the word IMI, it is quite crucial because most emerging market funds, they only buy large caps. IMI means large, mid, and small caps all included, so it's a much broader diversification than the standard EM fund. If you look at the top 3 holdings of EIMI, we have TSMC, we have Samsung, and SK Hynix. So you are essentially buying the giants of Asian semiconductor and the boom of AI tech. And these 3 companies are very important in the AI revolution. If we look at the top 3 geography, we are looking at China, Taiwan, and South Korea. On the cost side, we're looking at an expense ratio of 0.18% per annum. And this one is also accumulating, also Ireland domicile. So together, EXUS plus EIMI give you the non-US developed and emerging market exposure that compared with your SPYL gets you to something close to a full global allocation like VWRA. And the good news is both of them are UCITS ETF listed in the London Stock Exchange, and that means they sit outside the US estate tax regime, plus they have better dividend treatment, far more appropriate for Singaporean investors like us. And if you're asking me, where can I buy these ETFs? I use Interactive Brokers, VWRA, and this is not sponsored by them, it's just what I use because it's one of the only brokers that has access to London Stock Exchange, and the commissions are low, the FX is very favorable. So even though they are not sponsoring this video, but if you help me click this link or scan this VWRA QR code, it will be a support to the channel even if you already have an account. So thank you to all those who have clicked or scanned the QR code. And yes, I'll continue to provide better education and information on how you should structure the portfolio. But having said that, I think there's also one concern. Is there a cleaner alternative? Because I don't want to manage 3 ETFs. And I want to be upfront about this thing, right? The cleanest approach, I would say this very clearly, is to just sell away my SPYL position and move everything to a single global index like a VWRA or ACWD, which are the all-world index, right? That will be very clean. One fund, just one thing to manage, is globally diversified. I don't need to look at so many fact sheets. I don't need to put in so many buy-sell orders. But that is the thing that you can do if you are starting out fresh from white paper today. But if you are someone like me who already have a major S&P 500 exposure, and you don't want to liquidate your positions because of various concerns like the cost, or you just don't want to liquidate your profits, or you just simply want to have a manual control of how much allocation you want in US, non-US, or even emerging markets exposure, you want to control the allocation, then I feel that this is a good solution to have, the EXUS and the EIMI. Then you can allocate the funds according to your own preference. Okay, I'm not saying that you should follow my standard, but I'm just giving you an opinion or a suggestion of how you can allocate your portfolio. So the way I want to structure my portfolio is that going forward, my overall allocation shift towards something that is more balanced without me having to sell anything, right? So this is the middle path, and not everyone will choose it, but I just want to show you the logic and a specific tool so you can decide for yourself what makes sense for your situation, because I am not your financial advisor and I cannot advise you anyway, but I can help you show the direction of this is how you should think for your own portfolio, because our portfolios may be very different. And remember that past performance is not a guarantee of future results, because the US may continue to boom again and then I miss their trade. So it's okay, I just give up some of this outsized return, but you just need to think for yourself what you want to do lah.
Also, I've made all this information into a cheat sheet that you can download for free on my Ko-fi page. So head over to this link and download it for free right now.
And just to recap, I'm not selling away my US S&P 500 positions. I'm just adding more non-US positions like the developed markets outside of US and also the emerging markets, because I felt that their growth could be stronger than US at one point in time. And I'm okay to give up some potential gains for more stability. And if you really appreciate and enjoy this sharing, please help me click the IBKR code or scan the QR code here. And if you have any questions on EXUS or EIMI, or you just want to think through of your own allocation, do drop them in the comment section below. Okay, if it's a simple question, I'll just reply it. But if it deserves a video on its own, then I'll make a new video to address this whole new topic. Because I think investing is very interesting, right? Like different people look at it from different lens and everyone has different allocation. So yes, if you have any questions, leave down in the comments, like and share this video if it really helped you. But on the S&P 500 front, you also need to know, different S&P 500 ETF, which one is best to buy for Singaporeans? You don't know which one, right? Then you can look at this video that I done. The best S&P 500 to buy for Singaporeans right here.